Welcome to a special episode of The Get Down. I am Clev Messidor, CEO and Managing Editor of Butterscotch Media. We are very excited to have such a special guest lined up for you today. eToro US CEO Lule Demmissie. She's going to be talking about the transformation of the 21st century retail investor. As I mentioned, Lule is the US CEO of eToro, which is a social investing network that empowers people to grow their knowledge and wealth as part of a global community of investors. Lule previously served as the president of Ally Invest and as managing director of investment products and digital guidance at TD Ameritrade. Lule has also worked for leading investment firms such as Morgan Stanley, JP Morgan, Goldman Sachs, and Merrill Lynch. Now, before we get into the conversation, I want to set the stage a bit, sort of like set the table. The advent of fintechs, followed by crypto adoption, paved the way for the democratization of finance. As a result, retail investing has been transformed as non-traditional retail investors disrupt the exclusive club of investment. Our guest for today's episode says research indicates that the profile of a retail investor is actually below middle income and is no longer a rich man's gig. Lule, my butterscotch queen and king, recognizing your multitudes, welcome to the show.
Thank you so much. I'm so happy to be here with you.
It's such a treat to have this conversation with you. You know, we've known each other for a while. I'm a big fan of your leadership across fintech, across crypto. But before we dive into this conversation, tell us about your journey into decentralized finance since you started in the traditional financial space.
Yeah. So first of all, a pleasure to be here with you and your listeners. I started out, so to understand my journey in fintech, you have to understand that I'm an immigrant. So I came out of my country as a young person and like most immigrants kind of hopped all over the place and then came to America in my teens. And when I came here, I didn't have, my parents didn't have wealth to pass on, let alone wealth, lots of debt to be able to go to school was necessary. And when I finished college, I was an economics major. I knew that I wanted to understand the science of money. And I wanted to be in the business of understanding and engineering around money, not out of sort of like just because I wanted to get rich kind of thing, but I found it to be actually the centerpiece of why power exists. When you look at history in general, at this epicenter of so many things that happen in history, good or bad, is resource, money. And so for me, my fintech journey really began with that sort of like macroeconomic backdrop for me. But then I was lucky enough to actually find it intellectually interesting. So when I entered this space, I found the solving of investing, the figuring out of investment products and building stuff. I'm a builder at heart. All those fancy titles you talked about, really, the only reason I liked them and wanted them is because they gave me access to the building room. And I loved building products. And fintech to me was the opportunity to take this thing that I knew, which was money and the power of money, and to democratize it in a way that gave people access to how to accumulate it. If you look at the wealth gap in general, what you find is that the majority of what contributes to it is asset ownership. Right? It's a fallacy to think it's actually income. Income is important, but really the massive gap that exists in wealth gap is those who own stuff and those who don't. And more specifically, those who own things in capital markets that appreciate at a faster rate than anything else. So fintech to me was like, okay, this conundrum has to be solved and more people have to be able to have access to it. Not because I think everybody's going to become a millionaire. Everybody should get a shot at creating some wealth in their lifetime. whether they can pass enough of it off to the next generation, or whether within their own lifetime, they're able to make life a little bit better for themselves. Access to capital markets was essential to me. And that's kind of like what drove my interest to fintech. And lucky enough, technology made that accelerated experience.
Oh, I love everything you're saying, because you're really talking about going from financial inclusion to capital formation. And that could be that great equalizer.
When people talk about financial inclusion, it's typically about like linguistic decoding for people, right? People feel left out because they don't understand the language, or people don't know how to do a budget, or people don't know how to figure out how to save. And I think those are all very important things, but I go straight to the heart of the matter, which is capital formation. And as you said, that is to me, the key to why it's important to access capital markets.
100%. You recently wrote a Forbes article, you're a Forbes contributor. You wrote a piece on, this new investor, right? This new paradigm. And I'm going to share a quote from that article. You said, from mobile investing, trading, to lower minimums, to fractional shares, to digital assets, innovators afforded a broad cross-section of the American public access to the capital markets, and thus a means to augment their wealth. Tell us a bit more about that and perceptions regarding this diversified investor segment.
Yeah. So we did this survey. So eToro, who I work for, is an online trading platform with very low barriers to entry for people who want to invest, whether they want to practice investing with, fake money, or they actually want to invest in either stocks, crypto, etc. And so we get to see, because it's a global company, over 35 million users interact in our social ecosystem, and about 3+ million users globally actually trading and investing and funding their account. And so we get to have this privilege of seeing people behaviors around investing, but then we also do a quarterly survey to understand the psychology, where the investor's head is at, the retail investor's head. In this round, we decided to actually add a layer of identity to it. And so we put in sort of this prism of like, what are, Black people saying about this, people of color saying about this? What are women and men saying about this in terms of a gender divide and beyond that? What are different age cohorts saying about these particular topics? And we wanted to understand the psychology, not necessarily actual data that says 10% of people of color own X, but rather what they perceive to be is owned by people of color. And what we found, what's really interesting when we did the survey, is that people's perception of who is the character, the persona that sits at the epicenter of partaking in capital markets investing is drastically different from when I came up. So when I was coming up, it was all just white men who typically also played golf, right? That was the persona of like who was an investor. And wheeling and dealing happened on the golf court, and everybody else was really just sort of like, assisting this process. In addition, when I was coming up, the minimum, you would be lucky to find a minimum that was like 25,000 or even 100,000. Most minimums to do anything interesting investment wise were, 100,000, $1 million, et cetera, from a net worth perspective, right? So all that you just quoted is essentially the reduction of all of that, and just, it blew it up, right? It just blew up all these barriers to entries. And when that barrier to entry blew up, what we did realize is that the world didn't change all of a sudden. It's not as if, investors look diverse already at a pace that we would like it to be. But something more important happened, in my opinion, which is people's perception of who's in the room changed. And as we know, perception is the leading indicator to results later on, right? It's like that old saying, you can't be what you don't see, right? So we asked this survey and we said, when you look in the mirror and see who is the face of an investor, who is it? 60% of the respondents said somebody that looks like me. So the Black people said people like me. The young people said people like me. The women said people like me. That's a big deal. That's a huge deal that I see myself on the other side, regardless of what the actual stats are. That's an incredibly important thing. The second thing we asked them was, when you think of an investor, how much do you think they have? What kind of income do you think they make? And we were thinking at least $500,000, right? Like, just again, because we're living off of that same sort of investing is only the man's access, right? I mean, the level of income, I think the majority of people thought something like 70K or more. And then a good minority, like 40%, said 40K or more, people who make 40K or more a year. That means that the majority of people, perceive that partaking in the investing exercise is not a rich man's job only. Huge, gigantic. And there were several other things like that we saw, which is, one of the other things that's really popular is to perceive an investor to be naive, scared, shaking in their boots. And the level of confidence in which they described themselves to be investors, like when you see a retail investor, what do you think? Confident, collaborative, right? This is so heartwarming to me because I think that we have a lot more work to do to diversify investing. But one of the biggest things that I think that I saw in this survey, which is important, is that the mental block has gone, or at least it's been diminished.
Fascinating. And you're absolutely right. Perception matters. It shapes our impressions of people and ourselves. And I'm so glad you added identity to that survey, because we know that, working class people, young people, communities of color, they're not just driving the fintech space, they're driving the digital asset space. And we don't have enough data that tells us about these various segments, because data historically has actually not even attempted to capture diverse, inclusive communities. You're right. There's much more to be done, but this is an excellent start. Now let's talk a little bit about some of the things you've been doing. You recently spoke at the FINRA annual conference, and you talked about practical insights about retail investors. And interestingly, you posted on social media that today's retail investors defined by more than meme stocks. Now, obviously, I work in crypto. This is the larger fintech space. I get what you mean, but for our audience who may not understand the meme stock reference, tell us a bit about the FINRA conference and what you discuss and what you mean by this retail investor being beyond more than meme stocks.
In some ways, I feel like meme stocks have made it more culturally acceptable to talk about investing. But for those who simply, like, just a simple explanation is really the phenomenon that started, that heightened around COVID, in which a certain segment of securities or coins, in the case of digital assets, were chosen by a community of people as something that they want to rally around, either for speculative desires, right? Or because they felt like it expressed a social point of view, right? So if they felt like a particular stock was being beaten up by the hedge funds, for example, and they felt like that was their way of coming in and sort of counterpointing as a popular culture point. And as I said, there's also speculative reasons. And then there's also the entertainment factor of it, like people just feeling like it's fun to do. And I think that what I meant by they're more than meme stocks was not to necessarily put down that, right? As an advocate of investing, I don't go around talking about sort of like, I don't have like a parental sort of like a way of thinking to myself, this is the only thing people should do. Right. I just think the beauty of America is you have choice, right? And so you should, as a consumer, be able to calibrate your choice based on your risk appetite and your ability and your means, right? The reason why I said it's more than meme stocks is because I think the cultural desire to create binary frameworks for retail people is very strong. Like, institutional investors are considered to be very nuanced. They can manage risks. They can manage their customers' demands. They can be speculative, and they're allowed to be this like tableau of different things. And nobody goes around saying you're just one thing. With retail investors, I think the temptation to corner them into one thing, and typically that's one thing that's very short-sighted, is very high. And so what I meant by they're more than meme stocks is to say it's an and story. Yeah, they could do meme stocks, but they also, if you look at their behavior on our platforms, are buying single stocks in companies that they think are valuable, companies that they believe the thesis of their business model, whether it's technology companies or healthcare companies. They also partake in other types of investing instruments nowadays. So my whole thing is like, catch up to the retail investor. They've already become an and story. And let's not keep narrowing down and sort of their definitions, because the reason why I want to say that in front of a regulator is because the regulator is the cop on the beat, right? And if the regulator becomes too singular in their view of that retail investor, that very, very delicate sort of innovations that made it possible for so many people of color and people of and women to come in could get snuffed out. Right. So it's really important for me to go in front of regulators and other people to make sure that we stay nuanced when it comes to the retail investor.
I love that. I love so many aspects of what you said, but the last part is so important because I do think that, regulators and policymakers, they're not really understanding this new dynamic with young people and working class people and women and why they're, attracted to new investment opportunities and even speculative ones, as you've mentioned. But I love how you've shown the advocacy to these new retail investors that they're essentially using, their finances to make a statement, right? And I think of a few years ago where there was a lot of talk about people who bought stocks. I think they were called impact investors who'd who'd want to take a company down and buy portions of that stock because they didn't align with the values of that company. They felt that company should be broken up or whatever. So I love that revolutionary spirit that you've given them in your description.
Yeah. And the reality is, why is that good enough for institutional and wealthy people, but it's not good enough for regular people when they want to partake? So there's an elitism there that I think we have to examine.
Yeah. And I think that goes back, just like we were saying, going from financial inclusion to capital formation, we have to balance, consumer protection, which is where regulators and policymakers tend to live, with also capital formation and financial inclusion, right? It's one thing to say we have to protect investors, but if you protect them out of being able to participate, then you're doing more harm than good. Right. So it is really, how do we strike that balance?
Yeah. And I think the reason I bring specificity to that conversation when I partake in these things with regulators and otherwise is that specificity gives you an understanding of the downstream impact, right? So for instance, I'll give you a simple example. You can have a very draconian disclosure requirement, or you can have a very draconian how you do your exams and how you do your regular oversight of a business, right? From a regulatory perspective. And when I say draconian, I mean incredibly prescriptive and not necessarily being more guardrails, which I think are the right approach to any regulation. What happens is it's not just that company you're dealing with is then, feeling the pinch of that, but then their next best decision is not going to be for low balance accounts, because then the return on investment is not high for those individuals. So it's not enough. It's too much for that company to be able to keep giving access while dealing with this incredibly prescriptive, burdensome thing. And then without you knowing it, you've just iced out investment and innovations that could advance for these people. So ultimately, what I think is really important for us to give specificity is how much the downstream impact of very singular views to regulations could have. And it's literally two sides of the coin. You're absolutely right. You can regulate your way out of exiting them, or you can be so soft they lose all of their money. But that is the job of all of us, is to find that delicate balance and not to be lazy to think it's one or the other.
Absolutely. I love that. Specificity makes the difference. Now, we talked about speculation, right? And how this new retail investor is getting into the markets, testing it out. So let's shift our focus to risk, right? Because at the end of the day, any investment comes with risk, and the traditional financial markets are risky. I'll step back. Last December, I was so honored to join you at the New York Stock Exchange when you launched eToro's new research, the Rethinking Risk research that actually looked at, these new retail investors and how they were actually outweighing, fear of losing out with their fear of missing out. And I love the way you looked at that. And by the way, being on the New York Stock Exchange floor was on my bucket list that I didn't even have in my bucket list because it was amazing. I was never like, oh my God. I worked on Capitol Hill and I never walked to the Capitol and said, wow, like other people did. But I did walk through the trading floor and thought, wow.
Yes, indeed. Yeah, it's a lot of fun. It's a lot of history. So I think that risk is a really interesting one. And this is what I mean about specificity. So to a lazy mind, one could read, do you want to take more risk on? And somebody says no. And then to think that you're just supposed to shut off risk across the board. Speculation is a high risk exercise. Shut it off, right? And what I am seeing among retail investors is it depends on what pocket of their money they're talking about, right? They're not going to be doing that in their 401k, but in a brokerage account that they are exercising a wide spectrum of risk. Yeah, they'll take on more risk. They'll do more risky things and speculative things. And why is taking risk important? I can't believe I'm saying this. The reason why taking risk is important, and by the way, retail investors are teaching us that right now, is that without taking risk, you do not partake in the exercise of reaching for returns. Without risk, there are no returns. The other thing, reason why risk is so important is that it trains your muscle to endure. So when you look at some of our surveys, what people tell us is, I am worried about risk, as everybody should be, but I'm still taking it, is the second answer they give. So are you worried about risk? Yes, keeps me up at night. Are you still taking it? Overwhelmingly, yes, I'm taking it. How are you taking it? Depending on what bucket of money that I have and what sort of risk appetite that I have. And I think that that is exactly what we want for retail investors. Resiliency and practiced risk taking and an understanding of where it is that I should be exercising that risk taking. I think that speculation is a part of that spectrum. Again, you can take it or leave it as an individual, right? As an investor. I have no value judgment on either or the other, but it is part of that spectrum of risk taking that I think should be not just tolerated, but celebrated as part of the broader spectrum, just like asset allocation and diversification is.
Yeah. Because we have toolbox to help people mitigate risk. And when you look at what people who've been locked out of traditional finance, they're talking about generational wealth. They're talking about, building wealth for their families. And we know, as you've mentioned earlier, you can't do that through a 9-to-5. Having a good salary will not help you to build generational wealth or build equity and have a level playing field. So recognizing risk exist means that we have to make sure people are empowered with the tools to help mitigate risk and also, like you said, assess their risk appetite.
Yeah. And the other thing is, so we have on our platform a younger skew of customers, right? So it's millennials or younger is the overwhelming majority. And you could argue that it's because they're younger that they have a higher risk appetite, and they do. They have a higher risk appetite than the average broker-dealer platform. However, I actually think it's not just because they're younger. I think that this generation has understood that risk is a part of the equation because so much of the social contracts that were there before, they feel are not here anymore. Right. And so they are experimenting and thinking of other means as they see capital markets diversifying and giving the kind of returns that's maybe some traditional instruments that in the old days people would put their money in don't. Right. So I think there is a recalibration around risk, but there's also different textures of risk. Right. And this is what I mean about why do we keep putting the retail investor in a non-textured world? So I'll give you an example. People perceive principal risk, which is $100 that I put in, and I could lose that $100, differently than if they leveraged that $100 and took a margin debt, for instance, to be able to invest in. And when people choose crypto over and over again in this generation, it confounds people. I thought they said they were risk averse. No, principal risk is a different perception for them than if they levered themselves and did other things, right? And so I think there's also like different textures of risk, even when you've resized it for your particular risk appetite. Risk has different textures. And I love that retail investors are learning those textures because again, if you don't learn those textures, you can't be an adept investor. And if you're not an adept investor, you don't partake in the greatest sort of means of being able to have capital formation in your life.
Well said. Well said. And we've seen the digital asset, really disrupt traditional finance, making it accessible to more and more, as evident most recently by the Bitcoin spot ETFs that are now available to just about anyone through so many financial platforms and institutions, including eToro. So you just mentioned margins. I know you've been talking a lot about the options industry on social media and speaking at conferences. What's next? What should our audience be thinking about as they're looking at their risk appetite and wanting to go deeper?
Yeah. So yeah, we offer options. There's no margin on options, but we offer options on our platform, which is another means of exercising. The beauty of options, if it's suitable for you, is that it teaches you probabilistic thinking and investing better than any instrument that I know of. And really that is the key to becoming a good investor, to understand probabilistically my ups and my downs and figuring out if there are ways for me to sort of capture best upside with as little downside as possible. And different kinds of option strategies allow you to do that. So retail investors are very much engaging in that now, more so. Again, the pandemic changed all of that. But they're sticking around. Options adoption has been higher now than it ever was, right? And so options is big. People are still partaking, not just in, sort of the Bitcoin ETF that they buy on our platform, but also as what I call the raw material, the actual coins that they want to own outright, not just being intermediated through an instrument like an ETF fund, right? And I think people should just have, in my opinion, an all of the above logic in investing, because you never know where's the wind of opportunity going to go. And so what we don't want to do is lock people into one type of instrument and opportunity goes in another way and they don't have access to that instrument. So I'm always going to advocate for more democratization of more types of instruments, alternative investments one day, all other kinds of instruments that I think are going to be valuable for retail investors to play out their thesis on.
Well said. One of the things I love to tell people is that the more options an individual has, the more inclusive money becomes. We should not be taking things off the table. We should be adding. We should give people more options. And I'm glad you mentioned, especially we've had a Bitcoin futures ETF for a while. But the Bitcoin spot ETFs, most people do not know it gives you exposure to Bitcoin, but it's not the same as owning Bitcoins. And that's an opportunity that's accessible to everyone. So well said in terms of making sure people have opportunities to diversify their portfolio, especially new investors.
Absolutely. And it's not just about using it as a store of asset, right? So you may believe that, a particular instrument or coin has other use cases that are really valuable, whether it's because you think it's going to be, some sort of a technology enabler for payments in other spheres. There's so many other use cases that come with partaking in digitization of money, which is really what, digital currencies are about, that I think people should not be locked out of. Because what's going to happen? Retail goes out and only institutional gets to partake in that? How did that democratize anything? You just consolidated all wealth once again in the hands of the few. I think the dirty little secret about digital assets is it's a first asset class in which the regular Joes and Janes owned before the institutional class did. And I want more instruments like that come from the ground up, and not necessarily locks people out.
Yes, that's my favorite thing about Bitcoin. For a lot of communities of color, it was our North Star into digital assets. And we got there before Wall Street, before Silicon Valley, even before regulators. So it's exciting to contemplate what's next 10 years from now. Now, you've dropped a lot of knowledge, lots of pearls. Do you have anything you want to share with our, listeners in terms of any advice or suggestions?
Yeah. I mean, I think the best thing to do when you want to learn about this stuff, so you can imagine I'm very excited about this stuff, right? So one of the things that I try to impart on people, whether it's my family or friends, is that this stuff is fun. This is not just like a heady, boring thing. It's a really fun and interesting and intellectually engaging space. So I would just encourage people to lean into that because we won't do stuff that's not interesting to us, right? So lean into the interesting storylines underneath an investment, right? Whether it's the investment thesis of a stock or the thesis of a coin that you're interested in or an option strategy that seems to be fascinating to you, like really lean into the intellectual aspect of it. The second thing I leave people with is sort of like build yourself a moat of community. That's one of the things we find about our users as well as people we survey all the time. They learn with others. They have community around them. That's one of the reasons we built a social platform. So find your sort of community of either people you follow or people that you exchange ideas with, because it's a lonely sport otherwise. Make sure that you form community. And there's several cool ways you can do that. One is follow people that you think are interesting and then look at who they follow. And that gives you sort of like a double click through a chain reaction of some interesting people that you might be interested in. If you want to follow me on social media, feel free. I just learn from others all the time. And so I have a really cool sort of set of people that I follow, whether it's on X or otherwise. And then lastly, visit us on eToro. It's a really, really simple and easy, accessible platform, whether you invest with us or you practice investing or you just get your data insights from us. You want to make sure you're on platforms that really advocate for the retail investor and who design products in a way that is for them.
Oh my goodness. So I heard you develop your moat of community, lean in. And as you know, those of you listening, Lule is available on X and eToro's website is a great resource. We will be dropping that information within the episode. Any last minute thoughts before we close out, Lule?
Yes, I would say the one last minute thought I leave people is that, the temptation is to think you need to have money to become an investor. And that is not true. You just need to have some money. I started investing while I had massive loads of student debt. Money and participating in capital markets has an empowering antidote effect on the mind. It actually empowers you. And so when you're feeling burdened, and I'm not trying to give people advice here, if they can't afford it, they can't afford it. But really challenge yourself into thinking, what percentage, whether it's $1 or 50 cents, that I can do, because it has an antidote effect on making me feel empowered.
Great advice. Again, not financial advice, but very inspirational and aspirational. Thank you for joining us, Lule. And, we really appreciate the work and research you're investing in to get to understand more about the 21st century retail investor. That's definitely going to have an impact on achieving regulatory clarity, but also making sure that we understand this new, consumer retailer investor that's really going to dominate, the future of money and the future of finance.
Thanks so much for having me.
Thank you for joining the conversation. My butterscotch kings and queens, host Wisty P, will be back for our next episode with crypto OG Elena Geralt, who is founder of Blockchain Latinx. Thank you.